I'm joined, my name is Matthew Lamb, and I'm joined with Matt Roberts and a couple of the team from Fulcrum Asset Management. I know we have a heck of a lot of people dialing in from all over the world, so thank you very much for everyone taking the time in the various different time zones, and I know that you're extremely busy collectively trying to do your day jobs. So we're not going to take too much of your time up today, just going to try and give you a bit of a flavor on what's coming and the exciting kind of new launch that we've got that's actually been signed off by the regulator perhaps a little sooner than we thought, which means that we are ready to go extremely quickly. In fact, 17th of July, we're hoping to launch the strategy. The other thing is we now have all the ISINs. They'll be on the recognized fund list shortly, and Bev will send all of that round. And before the close of business tomorrow, you'll have all the strategy sheets and fact sheets and information sheets available on the strategy as well. So very quickly, let's try and just go through a little bit before I hand over to Matt. One second. Matt Roberts, who's the portfolio manager on the fund. So where are we with dVAM? Well, you know, dVAM has started incredibly well I think primarily for the reasons that it's a great solution for clients. We've seen the costs to clients of products come down, and we've seen that extra layer of regulatory protection provided by dVAM prove to be particularly useful, particularly in the world where Woodford and others have struggled, and actually those that have accessed Woodford through a dVAM type structure, namely St. James's Place, have been protected. And they've primarily been protected because they weren't invested in the Woodford fund. They just gave Woodford a mandate, and they were able to terminate Woodford and appoint another manager, and therefore protect their clients and give their clients that extra layer of regulatory protection for no fees. And that's exactly what the dVAM project is doing. I'm pleased to say that we're raising about 10 million a week into dVAM. At the bottom it says we're 200 and about 53 there. Actually, it's now about 265 million. And within dVAM and complemented by the Pacific funds, we were still acutely aware that there was probably not enough in the range for you guys to continue to choose dVAM as a whole solution for your clients. And one day we hope to get there. And we had a lot of discussions about what the next fund should be when we launched with dVAM, both with the dVAM Product Advisory Committee, but also a number of you guys around the world on what might be useful, particularly given how late we are in the cycle and given how expensive markets are. And so what we wanted to do was see if we could find a strategy that naturally complemented the existing strategies that we owned, the existing dVAM strategies. So something that was less focused on equities and something that was maybe focused more on diversifying the existing book of clients, something that was additive rather than just duplicating things that dVAM already had. And therefore what we wanted to find was something that was more exposure to, you know, alternatives, more, you know, non-directional type strategies. And that led us to try to find really people that specialized in nothing else but this, rather than trying to pick a manager that did hundreds of other things, but also happened to do something in alternatives. The interesting thing about Fulcrum is that diversified liquid alternatives is exactly what they do every day for all of their clients in some shape or form. And the great thing with the team, and I'll go through their process and their thinking, is that they spend a lot of time with us and the dVAM Product Advisory Committee to make sure the portfolio they built was complementary to the other dVAM products that we already owned. As a result of that, the other nice little sales angle is that you end up with a strategy that's completely exclusive to dVAM. So dVAM is beginning to help clients, but also attract really interesting asset managers that typically run assets for institutional clients only, and giving exclusivity to your clients in a strategy that complements everything that you already own. So we're really excited about it. That's enough from me. What I'm going to do is I'm going to pass over to Matthew Roberts, who's the principal fund manager on the dVAM Diversified Liquid Alternative Strategy. He will go through a little bit about Fulcrum and the high level view of the strategy and what it's trying to achieve. If you go to the top of your screen, you may see a questions box, or to the right of your screen. Please feel free to ask questions as we go through the presentation. Type them in there, and we'll try and address them either as we go or at the end. We won't go on for too long, probably 30 minutes, and then we'll open up for questions. So I'll pass over to Matt now.
Okay, well, thanks, Matt, and hello, everybody. Thank you very much for dialing in, spending the time listening about the new strategy. I'm not going to spend too much time talking about Fulcrum Asset Management. We want to spend the bulk of the time on the new strategy. But just very briefly to begin, we just wanted to highlight a few key things about Fulcrum. And so you'll see that we are an independent business. We were founded 15 years ago now by Gavin Davies and Andrew Stevens. Gavin is a name that you may recognize. He writes in the FT on a weekly basis. And if you look back through his biography, you would see that he was also chairman of the BBC and the chief economist at Goldman Sachs for many years. And so has been around the industry for a long time. And Gavin and Andrew have really set the culture at Fulcrum, which is one of producing great research. And so all of the solutions that we manage at Fulcrum are research driven and also highly liquid as well. So everything that we do is liquid and available in daily dealing format. We have three teams at Fulcrum: discretionary, systematic, and alternatives. And the total assets under management are just shy of 4 billion sterling. The dVAM DLA solution is going to be run by the alternatives team. That's the team that I run, and you can see the bios of the team towards the back of the presentation when it's sent round. But really, we just wanted to emphasise that sort of the size of our organisation, that just shy of 4 billion sterling, is big enough such that we manage money for large institutions globally, but also small enough such that the dVAM DLA mandate is really important to us, and it will absolutely matter to our team. And so we've put a huge amount of effort into developing it with Matt and the team at Pacific. So that's just a brief intro to Fulcrum. Let's move on to talk about the strategy. So what is it? DLA, Diversified Liquid Alternatives. The first thing really to say is that it is designed exclusively for you. It was a little project that we had with Matt and the team at Pacific to figure out exactly what was going to be the best new strategy that we could launch that would be complementary to the other funds that you already have available on dVAM, and also to the things that we understand that most of your clients already own. And that is in particular traditional equities and bonds. Why are we emphasizing that it's liquid? We're emphasizing that because the vast majority of alternative investments are not available through daily dealing UCITS structures, and this is. And that's because Fulcrum has a specialism in this area, and that's one of our competitive advantages. It's something that we've done throughout our history, identifying great ideas in liquid alternative markets and putting them into daily dealing structures. And so that's what we do as a day job. And then alternatives, just that really emphasizing the fact that it is complementary to traditional equities and bonds. And so that's the three-letter acronym, and hopefully it's reasonably easy to remember. What is it trying to do? Well, the solution dVAM DLA is trying to achieve cash plus 4% net of fees per annum over rolling 5-year periods, and it's attempting to do that with a volatility of around 4 to 8%. That is equivalent to around about a third to a half of the volatility of the equity market. So a relatively low volatility strategy compared to equities. And also the strategy has a low sensitivity to equities as well. It's been designed with that in mind. And so that equity beta of 0.3, what does that mean? Well, if you imagine that if equities were to fall by, say, 10% or something like that, if we had that sort of scenario, then we would expect this strategy to fall by no more than around about 3%. So that's the idea. It's that sort of level of participation in the equity market return. And hopefully, therefore, you get this complementary solution to your traditional equities and bonds. It's got three underlying components, three major components: listed real assets, alternative credit, and diversifiers. We're going to use the presentation to give you some examples of what's included in each of those areas. Here we just show you the key benefits of those areas, and we'll bring those out as we go through the presentation as well. And we also list out the sub-strategies. I'm not going to go through those sub-strategies in detail right now, but you also have a glossary available at the back of the deck if you'd like to read more about that. So that's your quick overview. The 30-30-40 that was a weighting mechanism, weighting mix that we decided on with Pacific and Matt and the team there. Again, just designed to maximise the complementary benefit of the strategy to what your clients currently own. Okay, so let's begin by digging into the listed real assets section of the portfolio. Really, the purpose of the listed real assets is to provide a bit of growth. So this is where we're really looking to achieve some decent returns in the portfolio, and also we will generally be investing on a thematic basis in this part of the portfolio as well, across 3 subcategories: so real estate securities, listed infrastructure, and natural resources. We're going to run you through a case study of one of the themes that's in the portfolio as well. But just quickly, just to bring it to life, we've got some pictures here of some of the assets that we will be owning in dVAM DLA. So you've got a couple of real estate companies there. So you've got Gecina, which is a French commercial real estate company. You've got Stag Industrial, which is a North American warehouse company. In the middle, at the top there, you've got Ørsted, which is a Danish North Sea wind company. Then you've got Verbund, bottom middle, which is an Austrian hydro manufacturer, and that's a hydro facility there on the Danube River. You then got Rayonier, which is a North American forestry company, and SalMar, which is a Norwegian salmon fishery company. So you can see the breadth of the different types of assets that we'll be gaining exposure to. These are all listed, so they are traded on the stock market. And so I hear you ask, why are these different? Well, they're different because if you look in a typical traditional global equity portfolio, you will find either a very low weight in these strategies or they'll be non-existent. In fact, many global equity managers just don't include these sorts of assets in their portfolios. So they are very much complementary.
Matt, do you want to explain in a minute or two, what do you mean by real assets? What classifies a real asset when you guys are to look at it? Because you're not going to own Google, I guess.
No, that's absolutely right. So by real assets, we mean things that have either come out of the ground or sit on top of the ground, essentially. So that's the kind of simple definition of what we mean by real assets. And you can see that all of those things subscribe to that definition. They're the 3 main categories that we include in real assets: real estate securities, listed infra, and natural resources. And why don't we do an example just to bring it to life? Okay. So this is a listed infrastructure example, and we're going to do some clean energy. Well, clean energy is a theme that I'm sure you're all aware. It's been a high prominence globally. Everybody's been talking about clean energy, and there's been a massive move to clean energy globally, particularly in the developed world, but that's expanding into the emerging world as well. If you just look at what's happening in the offshore wind market, there's a predicted growth rate of over 14% over the next 15 years in the offshore wind market. And so as a result of that, there are likely to be huge investment opportunities in this market. And that's very, very interesting for something like dVAM DLA, where we're investing in listed real assets. Clearly, there are risks to a strategy like this. So we have to be careful about things like political risk and governments challenging the subsidies that are available on things like wind and solar energy. And so what we decided to do in the dVAM DLA solution is develop a theme which currently is around about 4% of the overall portfolio, a theme that it has very broad exposure to clean energy. So we've got companies in here that are biomass companies. We've got wind, hydro, solar companies. And we've recently also included a geothermal company. So there's that Swedish company there near the bottom, Nibe, and they make ground source heat pumps. And so there's a really interesting mix of different companies to diversify us away from that sort of risk.
So the idea is to capture the kind of the clean energy theme, but without taking the kind of idiosyncratic stock-specific risk of any one company.
That's 100% right. So we designed the theme to be diversified across 12 stocks. So no more than about 0.3, 0.4% of the portfolio in any individual stock. There's a liquidity limit, so every company has to have at least a market cap of $1 billion and an average daily volume of $5 million. And so what you'll see, and then also that sort of diversity across the different subsectors. This is a theme that we've had exposure to in a number of our other portfolios. And so far this year, this theme is up over 20% already. And we think there's room for that to grow. We think this is a really interesting long-term theme where those sorts of returns will be repeatable over a reasonably long time frame.
And one more question just on this particular theme. Clearly, the dynamics of the theme, as you've explained, I think no one can deny the long-term story towards cleaner energy. We're seeing this in things like battery technology and wind farms and everything else. But do you think there's another thing driving this theme in the sense that we are getting asked, and I know the guys at dVAM are getting asked more and more and more about social responsible investing, and I know you'll talk about this a bit later, but are you seeing a lot of people drive these stocks up as well as a function of the fact that nearly all those stocks tick that kind of clean energy, that kind of socially responsible bucket?
Absolutely. So the socially responsible investing is integrated all the way through the dVAM DLA solution. And part of that is that we're positively seeking out positive scoring themes from a responsible investment perspective. And clean energy is one of the most obvious ones when it comes to that. And so one of the things that we have seen is that there isn't just a fundamental reason for investing in these sorts of ideas. There's a really interesting market technical going on as well, which is that you are seeing large swathes of the investing community now exclude certain stocks from their portfolios, which is leading them to consider some of these types of themes, which creates that really interesting long-term technical. And so we think that this is interesting for a couple of different reasons, not just the sort of traditional fundamental reasons. I'm going to move on to give you a case study on alternative credit this time. So what we won't do, we won't run through the high yield bond element, the convertible bond element, and the securitized bond element in this part of the portfolio. I'm sure we'll get to do that in future presentations. We've just got a little case study here on emerging market debt, which forms the largest part of the alternative credit allocation. This is
just remind us, alternative credit maximum 30% of the portfolio, is that right?
Yeah, so that's the target allocation, around about 30% to alternative credit. The key purpose really of the alternative credit allocation is that we're providing income. So you've got the growth coming from the listed real assets, and you've got some income coming from your alternative credit, and we're aiming for a really high and solid level of income coming from the alternative credit part of the portfolio. And it's supposed to be different income to the income that you'll be getting from your other bonds, the bonds that you might own in the other holdings across dVAM and in other parts of the client portfolios. And emerging market debt is a really key part of that. And currently we have out of the alternative credit allocations, that strategy has the highest weight. And here's the reason. The reason is that if you look at a typical government bond, here we've got the UK 10-year, and actually this data is a couple of months old. That yield on the UK 10-year is no longer 1.1%. It's unfortunately now only 0.7%. So if you were to hold a UK government bond for the next 10 years, that 10-year bond, you'd expect a return of less than 10% cumulatively over that 10-year time frame, which really isn't going to be enough for most investors. But if you compare it to a Brazilian 10-year government bond, you've got a yield of 8% or more. And so over that same 10-year time frame, assuming you don't have a default and the currency doesn't move, then you'd expect to double your money in that Brazilian government bond. Obviously, again, there are risks. So you've got that credit risk, you've got currency risk, and you've got some political risk with Brazil. So we don't just own Brazil. We diversify and we own Mexico and South Africa and Indonesia and a whole range of other countries. No country is more than 1% in the portfolio, very diversified, and you get that really interesting yield pickup. And again, so far this year, this strategy, which is currently 12%, has delivered around about 7% this year.
Are you buying these in their local currency, or are you buying their dollar-denominated bonds?
We actually do both, Matt. So we have a specific basket in the local currency bonds that forms around about half of our EMD allocation, and that includes these countries and others. And then we also have two external managers in the portfolio as well that we own, They buy a mix of dollar-denominated bonds and local currency bonds. They also do buy some emerging market corporate bonds as well. So we're getting that yield pickup across the whole portfolio of at least 5 or 6%.
And not to go on too much of a tangent, but I guess if the US is slowing down a little bit, and as many of the guys know, the rhetoric coming out of the US now is cutting interest rates rather than raising interest rates. Does that mean that the dollar's less likely to strengthen, and as a result, some of these emerging market kind of debt strategies become even more appealing?
Well, I mean, if you went back to last year, I mean, some of the emerging markets were really challenged last year because people thought that the US economy was just going to the moon, and as a result, the US base rates were going to have to rise significantly to counteract that. That no longer seems like it's the case, and as a result of that, with ever lower bond yields in the US and in other parts of the developed world, hopefully that creates a better environment for some of these emerging markets as well to thrive. And they're definitely at an earlier part of their economic cycle compared to a number of the developed market countries. And as a result, we think that, again, there's at least a couple of reasons for why this opportunity might pay off. I guess just finally on this one, think about the level of debt that we have in the developed market in the US and in the UK. And yes, there's debt in the emerging markets as well, but the quality of the balance sheets now in the emerging markets has really improved over the last 5 to 10 years. And so, again, that gives us
emerging market countries have better balance sheets than developed markets.
Yeah, absolutely. And again, that gives us another reason to be confident about this sort of allocation. Overall, though, still diversified, not making up a large part of the portfolio. And so if we're wrong, we've got lots of other allocations in the portfolio that are there to help us. Okay, so that's alternative credit. We're going to do diversifiers now. So that really, the purpose of the diversifiers element of the portfolio is and it's the highest weight in the portfolio. No surprise there, given the name of the strategy and what this part of the portfolio is supposed to do. This is really there to provide access to different ideas from the world of hedge funds at a very reasonable price. And something that we've been doing for over a decade at Fulcrum. And really,
this makes up nearly half of the portfolio.
That's right. The sort of target weight here is 40%. And really what we're looking to do is to take advantage of first mover excess returns. So at Fulcrum, we've got a history of investing in new product launches from established teams. And we believe that results in a number of key benefits. First of all, additional returns because you get in early. Second of all, you have the ability to influence the fund design and operational setup, much like we've actually done on dVAM DLA with Pacific. And also it results in highly attractive fees and terms, often better than anybody else is able to get because we're going in on day one or very early. And so they're really the key reasons for why we do this.
So the idea here, just in summary, is that you're scouring the world for investment talent that runs non-correlated type strategies, and you're backing them early. And one of the things to back them early is that, one, they tend to have a bit of an information advantage if they're going early, and two, you get to squeeze them on fees to make sure that you can kind of get the best and the most appropriate discounts coming in. Use your kind of institutional scale to get those. And it's something you've been doing for forever.
That's exactly right. And on this page, on page 10, we've got a number of examples of how we've done that. These are just selected examples. So we've done this many times over the years, but we picked out a few of the particularly interesting ones that we've been involved with over the last 10 years. And you can see there that this 6 ideas listed there, and cumulatively those funds, having started at 0, each of them are now in total over $9 billion. And each of them have produced really, really interesting returns for their investors. And a number of these will be included in the dVAM DLA solution, including a couple of the ones that are listed as closed here because we've got capacity with some of those managers still. Fulcrum does. And then you'll also get all of the future ideas that come through this process where we invest early with some of these managers. So this is the sort of thing that we're bringing here, and that's really the key point here is the exposure to what we think are underrepresented assets, and that flows through the whole of the dVAM DLA solution. In the listed real assets, underrepresented. A number of the alternative credit solutions underrepresented, and here as well, these really are underrepresented in a lot of client portfolios, and this is an opportunity to get exposed to those things. One of the things you might have noticed as we've been through this is that we tend to implement these strategies in a number of different ways. It could be that we think an idea is best implemented in a passive way through an index fund or an ETF. We don't do that often in alternatives, but it's there as an implementation route if we need it. If we think the best thing to do is to access a theme actively, we'll tend to use a highly skilled third-party manager. And also where there's a bespoke theme, something like clean energy, and half of our EMD allocation, there we will implement directly in a bespoke fashion unique portfolios that are created just for this solution. And that's something that really helps us get the cost down and provide that exposure to complementary assets.
So those themes we looked at earlier, when you looked at the kind of the wind and the salmon farming and all those things, you're getting access to those not via another manager. You're buying those companies directly through your own research and your own baskets, and those clients will end up in dVAM DLA owning those individual companies directly, which saves an extra layer of fees as well.
You've got that. That's the whole point of doing that. So on a number of occasions, something like clean energy is actually pretty hard to access passively, and there's not that many active funds out there. And so if we think that it's a really interesting theme and we think our clients should be exposed to it, then we'll create something bespoke and get that included in the portfolio.
Very broadly, would you say that, I don't know the answer to this, but so I may be wrong, but would you say that the vast majority of the bespoke themes is done directly and the vast majority of the alternatives piece is done through active managers?
Yeah, so what you would expect to see is just less than half the portfolio done directly, bespoke. Most of the listed real assets is done bespoke. And then on the active side, just more than half of the portfolio, most of the diversifiers done through third-party managers. That's what you should roughly expect over time. And really, this is a research-driven process. So we're all about coming up with great ideas that we want to include in the portfolio that provide that different underrepresented exposure. And I'm sorry I keep repeating it, but it's very important that we provide that complementary exposure for our clients.
So then from a fee perspective, this is really to the guys out there, the TER of this strategy will be somewhere between, and we're just kind of finalizing all the numbers, but it'll be somewhere between dVAM Guinness and the dVAM multi-asset GAM funds run by GAM. So and that kind of sort of makes sense when you think about it now. If half the portfolio is buying direct securities like a Guinness and half the portfolio is buying active managers, you're going to see a TER somewhere between the two. And so it's quite complementary from that perspective as well.
Okay, and so we just moved on to the portfolio now on page 12, and we've talked through a number of these elements. On the right hand side, you've got the strategic mix. So this is what you should expect on average for the portfolio over time. And then on the left hand side, that's the sort of the live portfolio, what it would look like today. And we've already talked through a number of examples. So we've been through clean energy, which is in the infrastructure part of the portfolio. We've been through EMD. We've been through the diversifiers allocation. Just a couple of examples of new things that have been included in the portfolio recently. Again, another listed infrastructure idea. We recently included a waste and recycling idea, rapidly becoming a very important day-to-day part of our day-to-day lives, recycling. And this is a huge growing part of the economy, and as a result, a number of recycling centres are benefiting from that. And so we wanted to include those real assets in the portfolio. Actually, we recently just augmented our high yield exposure in alternative credit. So we've invested in a new third-party manager fund there, which is a short duration, sustainable high yield bond product. That's been included in the portfolio recently at extremely appealing fees because we were a day one investor in that fund. And then the diversifiers portfolio, we've just done the same with an event-driven manager called Magnetar, and we were a day one investor there and achieved extremely compelling fees on that strategy that's looking to invest in merger and acquisition situations. So just to give you an idea that those new ideas will be flowing through into the portfolio on a reasonably regular basis in this sort of portfolio because of that research-driven process. So how would it have done? We've got the back-tested performance here of the dVAM DLA portfolio. This uses index data and also live data for the diversifiers element of the portfolio, which is something that we've been running for over 10 years. And you can see there since inception a really solid return, and this includes going through that global financial crisis period as well, really solid return of nearly 5% per annum.
I mean, it's important to remember, guys, that this is a cash plus 4 product. I mean, of course, if cash was 4, we'd be looking for 8. If cash is 0, we're looking for 4. I mean, what we're trying to do is make sure that we don't get distracted, or the guys are trying to make sure they don't get distracted what the peer group does, don't take unnecessary risks, because the secret is to try and be different to what you already own and focus on that outcome orientated approach, which is about delivering this cash plus 4, rather than this approach of trying to see what the competitors have done. I'm not suggesting one way is better than another, but what I am suggesting is that it's very different to the other strategies that you own. So don't get, this year I know the guys are up 10%, so they've had a fantastic year. But the focus for these guys is to make sure they deliver on that target return of cash plus 4. And that's what they're going to build the portfolio to do.
Yeah, and just some summary stats for you. I think there's some really important stats on this page. So you can see here that the since inception and 5-year sensitivity to equities just on the right hand side, there's been very low, 0.2 and 0.4 respectively. That volatility has been right in the range that we would have expected, 4 to 8%. And a good solid Sharpe ratio as well. I think one of the other things just to mention is when you have a really bad down year for equities, 2008 type down year, you see this strategy fall by a lot less. You can see that in the 2008 timeframe here. But also what happens in the year after that, the year after the down years, is you get that really strong and quick recovery. If you look at when there were down years, in each of the following years, there was a really good solid recovery that got the money back and more within a very quick time frame. And just to update you, this is up to the end of April. Just to update you, the year-to-date numbers now we're over 8% year-to-date 2019. So it has been a good strong year, with a lot of the returns coming from some of the listed real assets, but also the diversifiers have been performing really well as well. Just quickly on there, one recent observation as well. You may remember in May was a tricky month for equities, where they were down 6%. dVAM DLA solution in May was down 1%. And then in June, with equities rebounding by about the same amount, equities were up about 6, dVAM DLA was up 2. So that gives you the idea of the sort of participation that we're looking to achieve in the down markets and the up markets. So we've talked about what it is, what's included in it, what it's trying to achieve, and how it would have done. Why now? So this page really just shows you that a few key reasons that we think this is an interesting solution for clients at the moment. The first and most obvious one is, you've probably picked it up through the presentation. The market cycle is pretty long in the tooth. Equity valuations are certainly well above average. And they're certainly not cheap. And the same also goes of traditional credit as well. So traditional credit markets are very tight. And as a result of that, we think there's a pretty strong case to include some diversifying assets in a portfolio. We're also seeing some very clear mega trends establish themselves. So demographic change, we've seen that a lot in the developed world, particularly in the UK, the US and Japan, countries like that. Climate change is becoming ever more obvious. And the technology revolution. All of these themes are things that we can take advantage of in dVAM DLA, particularly in the listed real asset section of the portfolio, but we also do that across the whole portfolio. And we don't think that there are many solutions out there that give you that exposure. And so that's another reason why we think this is different. And despite those high valuations across the equity markets, if you look really hard, we think there are still pockets of value. And so one of the examples there, the clean energy example, that's something that you do here, and we think it's a really interesting pocket of value. So that's the kind of summary of why now. There is another reason as well, though, and that's this integration of responsible investing that Matt mentioned earlier. I don't like using the words hot topic, because it shouldn't be a topic. It should be something that goes on for a long time, but it's certainly something that's been paid a lot more attention by investors recently. We wanted to, when we developed this with Pam, we wanted to have this integrated into the strategy from the get-go. Every investment gets scored on ESG.
Remind everyone what ESG stands for.
So environmental, social and governance factors. Every investment gets scored on each of those factors. We're positively looking for positive scoring ESG investments, such as clean energy. It's overseen. We have our own responsible investment committee. I chair that committee. It's got a range of other investment professionals on it and non-investment professionals to give it a really good balance. So our process is overseen by that. And Fulcrum is also a signatory of the UNPRI. Why is this a reason to invest now? We think, again, just because of that behavioural element, the movement of people into this sort of thing creates that interesting momentum, which is another good investment reason for investing.
And frankly, I mean, to take a non-investment reason that I think that this is kind of important is that, one, being a signatory of the Principles of Responsible Investment, I think is incredibly important, and it's a prestigious list of people that are signatories to that. But the other thing is that this is the hot topic for investors. This is a hot topic for your clients. I mean, often, you know, in the same way that we saw passive become much more interesting when it moved out of, you know, the financial journal, you know, kind of rags into kind of mainstream papers. You would start reading about passive investing and does active really worth the fees. You would start reading that into mainstream press, which is why, you know, it would be in things like the Daily Mail business section or the Sunday Times, which is why clients started to ask you about passive investing and ask you about fees. And I get asked a lot from the various teams around the world and various other clients that we deal with, you know, do we have anything that is really strong where they think about, you know, environmental, social and governance and principles of responsible investing. And what's really cool is that now when you have clients that are interested in that, you are dealing with a firm that's a signatory to the UNPRI that looks at every company and investment through the lens of this environmental and social governance factors. And I think, although I'm sure it makes fantastic investments reasons, the key thing is that your clients are going to ask you for that. And it's absolutely important for dVAM and dVAM to remain relevant and responsible at the forefront of things. It's not just about creating things like apps and technology. It's about embracing some of the changes that as investors that we all need to look to embrace. And so I think it's a really important point that your clients will start to expect and that you'll be able to tell them that you're well ahead of the game.
Thanks, Matt. And I guess so perhaps just bring it all together now. You know, hopefully these elements have been sort of brought out through the presentation and they're reasonably clear. But this is something that's been designed exclusively for you. dVAM DLA, we don't run it in this form for anybody else. We think it provides that complementary underrepresented exposure across all three areas of the portfolio, which is different to your traditional equities and your traditional bonds. And there's a really interesting market opportunity currently mentioned. And so they're the three summary points to the presentation. I think with that, Matt, unless you've got anything you want to add, we can move on to questions.
Well, let's move on to questions. I hope that made sense to everybody, and I hope that, I mean, I've had a few WhatsApps from people saying that actually they think it's perfect. That nice steady returns I had from someone. What did they say? Perfect stable performance, ideal for a pension. And I think that's exactly right. People with longer term stable thinking that want to stay in the markets, investing in something like this alongside some of the other stuff is important. We've got a question where somebody's asked, if you've got questions, please feel free to put them through the Q&A box at the top and just put those through. And it says, are the subsectors managed externally or internal managers? So, and we covered some of that, but just remind us, you know, within the portfolio, what's the mix between the stuff that you do and therefore it's cheaper and you're using your own internal IP versus the stuff that you're trying to find the best of breed managers externally for?
Yeah, so the summary on that is that around about 40% of the portfolio is internally managed, directly invested, and about 60% of the portfolio is invested through third-party, highly, you know, in our view, highly skilled, active managers. And the bulk of those external active managers are in the Diversified section of the portfolio, and that's the reason for that is because that's where we think we can get the most skill coming through in the portfolio, the most differentiation.
Yes, I guess the interesting thing there is that where you're using active management in areas that you simply can't get a passive allocation to. it's difficult to get a passive allocation to an alternative, I guess.
Yeah, and that's part of the philosophy, which is that we want to be as impartial as possible about implementation. So if the team has an idea, and we're all about having great ideas in the team, implement it. Our next job is theories, and we'll be passive or some bespoke direct implementation. We just want to invest in the best possible way for the right idea.
Question: how liquid are the real assets?
Yeah, well, the whole portfolio is daily liquid, and all of the real assets could be sold in a day as well. So they are listed real assets. They're traded on the stock exchange, and they all have minimum market cap values that we can get in and out of on a daily basis. Any external managers that we invest in across the whole portfolio, they're all daily dealing as well, and so the entire portfolio can be liquidated in a day with a little bit of settlement time, no more than. It's a highly liquid portfolio. We certainly don't invest in unlisted or unquoted companies in this portfolio. It's designed to be liquid.
Okay, we are. Oh, sorry, Mark.
I was just going to add to that where we do invest with external managers, we scrutinise the underlying liquidity of all of the holdings as well. So you shouldn't end up with an illiquidity.
Yes, that makes perfect sense. And actually, so you've asked another question.
Sorry. I'm just going to repeat that because I think it was difficult to hear. Where we do invest in external managers, we don't just rely on the fact that the fund is daily dealt. We do underlying liquidity analysis on a regular basis as well. So we understand in great detail the liquidity of the underlying holdings as well.
So that answers a question which we've had from Doug and the team in Hong Kong. Seems to be two methods of questions. There's my WhatsApp and there's the questions through there. So Doug's asked the questions. Can you explain why it says liquid investments if we're investing in things like wind farms? Why? I mean, are they real? And I think it's the point you made there. We're not investing in any private businesses. We're only investing in listed businesses that specialize in those sorts.
Right. So which is the Danish wind farm of that company. So that exchange and is so daily tradable, very easy to buy and sell, and that company owns the wind farms. So that's how we get exposure to the wind farms. What we're not doing is buying private businesses that are invested in these sorts of activities. That would be too illiquid, and we wouldn't be able to sell it if there were redemptions in the fund, for example.
So Mark, very quickly, you mentioned that when we're investing in alternative managers, that those are also liquid. What sort of, because we've had another question on that, what sort of alternative managers are we doing? I guess these aren't private equity managers. These are people that are trading some of the most liquid instruments, but just in a different way. Is that right?
Yes, that's right. So examples, so I'm responsible for the credit investments. So we'll be looking at high yield bond managers, mortgage-backed and asset-backed security managers, where they will have quite distinct investment processes and philosophies that take you away from just a basic high yield bond fund or a basic this and that, so that we think there are lots of different sources of excess return for them to generate from the broad opportunity set. And we do tend to go for more unconstrained mandates to maximize the skills that they have. And obviously there's a higher hurdle to returns with external managers because they have fees to pay. So just as with in the diversifiers portfolio, we try and be innovative, nimble, and negotiate aggressive fee terms for our clients. We do the same in the credit basket too.
Okay, and then there's one more question on the alternative bucket, and I think the important thing is that just so that everybody realizes, when we think about the diversifying bucket or the alternative bucket, those are these highly liquid traders essentially that might be trading interest rates in government bonds. They may be trading long and short equities. This is not alternatives in the sense that we're doing private equity or you collateralized loans or longer term, less liquid type strategies.
That's exactly right. The one risk premium that we're not charging risk premium. Diversity of different is not one of them.
Okay. Platforms. That is are available. So the offer period is open for the dVAM DLA fund as of today. So as you get the ISINs, you'll be able to place trades. The fund will launch on the 17th of July, and it's available on all the platforms, all the single dVAM as a whole is available on many of the regular platforms, and this fund will be added to those regulars in the coming months. So all the dVAM funds are available on Zurich, on Hansard, soon to be Friends Provident International. The other dVAM fund registered for sale in Switzerland. We've had them registered for sale in the UK, and we're also looking to get them registered for sale in the Middle East. There's a question, and coupons reinvested. The answer to that is yes. There didn't seem a great point of distributing dividends and incomes because only 30% of the portfolio is income generative. So if that 30% is yielding 5 or 6, then actually at a portfolio level, it might only be 2. And as a result, it makes much more sense to reinvest them. Question on what the risk profile of the fund is. We might be cutting out, so I don't want to go on for too long, but please feel free to get hold of me or Freddie or Tarek or any of the guys. But just a question on the risk profile of the fund, where someone's asked a question there, is we definitely see this when you look at the RFL, the recognized fund list. This will be in the defensive, cautious and balanced buckets. So we definitely see this as a lower risk, steady return profile. But of course, if you're buying dVAM Global Equity Income to smooth those returns, this would also make a great complementer. The funds are available in South Africa, but they're not FSB registered as yet. Available through the trust structures, but you'll need to speak to your local compliance. Last question. There was a question. We've explained really.
Repeat that.
What is beta?
No, just repeat the whole bit.
Oh, right. Sorry, we may have got. There seems to be we're getting cut out. So if there are any questions, just let me know. Just to remind everyone, the dividends and coupons are reinvested. The funds are available in South Africa through your trust structure, so you'll need to speak to your local compliance. They're not FSB registered. They are registered for sale in Switzerland, and they'll soon be registered across the rest of Europe. They're registered for sale in the UK, which makes them SIP eligible. The question on what the risk profile of the fund is, they'll be on the recognized fund sheet, a cautious, balanced, and all the defensive profiles as a standalone investment, but also available in growth as a complementary investment to something like dVAM Global Equity Income. Beta, we wrote a book called the Jargon Buster book because the industry loves jargon as margin, and so. But beta is all it is the sensitivity of an asset to another asset, and in the case that we're looking at, the sensitivity of the fund to the equity markets. So if the equity markets are up, a long-term view, we would expect this to say be up 3. If the markets were down 10, it would be down 3. So the short-term sensitivity, is linked. When we look at it against the equity markets, it has a very low sensitivity to equity markets, which basically is another way of saying its returns are derived from other things, which is exactly what we'd expect because, it's a liquid alternative fund. So I think a lot of your Freddie Streeter, who you all is an expert. The guys, the sales team at Fulcrum will also be in touch, Howard and Matt, and I think they will get involved as well. Of course, there's a conference, obviously at the end of August for Western Europe, where Fulcrum will be one of the lead presenters, and we will get out on the road over the coming months and towards the year end. As I mentioned,